Welcome to readtheticker.com. The question I'm going to try and answer today is, when does this all end? When does the trend from the March 2009 lows on the S&P 500 to 89 months of higher highs, when does the stock market trend end? The yellow brick road eventually comes to an end, to spiraling down to nothing. So now we're going to try and find out how long we got to go on this yellow brick road. And my weapon of analysis will be the big channels. What are the big channels? In readtheticker.com, we have gone to the extra length to get very long-term charts. For example, we have the Dow Jones for 200 years. We have the 30-year bond for 100 years. We have inflation data for 100 years. We'll have the Australian All Ordinaries for 100 years. We have foreign exchange from 1972. We have lots and lots of commodity data, gold data for 100 years. And what this actually shows is long-term trends with long-term channels. Now, the stock market really can be divided into two things: the real market and the market that's pumped up and played around with algorithms. A real market, I would suggest, is the Russell 2000. Right, here we have the Russell 2000. It's been held by a big blue channel going back to 1990 or 2000, and it has failed here and there. It'll probably be consolidating into the upper range of this channel here. Now, this is the higher risk stuff. Less volume. Excuse me. So therefore you can see the trend is not the same as S&P 500. It's the underlining of the market. Another interesting example is, if I can find it, the NYSE. Now, this is 2,000 stocks. And as you can see, it never really tried to take out the highs of 2007 but failed, and it fell back deep. A lot of it's because a lot of stocks sold underneath the headline stocks have suffered. Comparing that to the show pony S&P 500, we've got that somewhere. Here we go. S&P 500 is 500 stocks. As you can see, took out a massive new high and has rallied up quite strongly because it's easier to manipulate the index with only 50, 60, 70 stocks to get the thing up. And now to answer the question is, how long has this got to go? Well, the easiest way to do that, I believe, is to look at the stuff that's really nobody really buys with any risk on assets. It's really safety. It's the Dow Jones Utility. The Dow Jones Utility is made up of electric companies, water companies, gas companies. The stuff that, yes, it pays a dividend, but really it's not exciting. They churn out the water, churn out the gas, and now it's reaching incredible all-time highs. For example, we've got a peak here, a peak there, and a peak there. Each peak attracted some sort of classic consolidation pattern in 2000, 1967, there's the other one here, 2007. As we can see, the next peak to expect is imminent. So this is probably a rally to about 800, I would think, another 10% move if you're lucky. Maybe consolidation for 6 months. So a lot of people are saying 2016 is the crash. I would say I would suggest that 2016 is the last or the dawn of a very rough time, and 2017 will be very, very interesting. Now, to back up the statement, we have gold and silver shooting up, taking out new 2-year highs. Bonds is shooting up. So as you can see, the defensive side of the investing is being very aggressive. So a lot of people are piling defensive stuff, and gold, silver, bonds, US dollars going up. And obviously the utilities are going up. So I suggest that when this runs out, it starts to consolidate and to show distribution at this higher upper channel, this is the time where we are dawning on some very, very risk-off action. Add to that why, I mean, you can look at two of the top banks in the world, Credit Suisse and Deutsche Bank. They're creeping into lower lows, nearly to break into I think Deutsche Bank is about $12. It could break into teens. But it can still hold this up. It can still hold the show up for 6 to 9 months, which is exactly what this chart is showing. It could creep up here quite aggressively, get close to 800 and then start doing a consolidation pattern. So I would suggest you keep this chart in mind and realize that there's something very big on the other side of this cliff when the Dow Jones utility starts to consolidate between 770 and 800, and especially so going into into October, November this year, and obviously rolling over in 2017, because 2017 could very much mirror these time frames here. Why would this basically happen is because the PEs on these gas and water companies just get ridiculous. So keep an eye on that, folks. The next 9 months, I would suggest that the new trends dawning in defensive areas and defensive sectors have got a lot longer to go, and now the stock market's just been held up, allowed distribution to those folks who just haven't worked it out yet. But watch those climbing defensive areas and that gold, silver, bonds, and US dollar, because the stock market is looking for gains, and now they're hunting in gas and electric companies and water companies, so you know it's not right. So keep that in mind, and thanks for watching.